Welcome to this webinar on building an in-house bank to enable business growth. I'm Marielle Barkley, the editor of this award-winning Global Treasury Leaders Program, which is organized by the Economist Impact and supported by Deutsche Bank. The program has two objectives. On one hand, to share thought leadership, and secondly, to connect treasurers around the world. And we do this through a series of events every year, which include summits in 3 regions, webinars like this one you're attending today, articles, and an online community where we host all these contents. The community is open to corporates only, so if you're a banker or service provider of any kind, unfortunately, you will not be able to join. But having corporates only allows treasurers from all over the world to connect and exchange ideas on any topic of their interest, and it is totally free for corporates. I am now going to send you a link via the chat facility so you can join if you would like to. Just remember to choose the Global Treasury Leaders Network when asked what groups you would like to join. There are several, feel free to join as many as you like, but Global Treasury Leaders Network is what you want for this one. But going back to today's webinar, the idea is to make this session as interactive as possible. So please ask as many questions as you would like using the question tab, not the chat, and please send them to us as soon as you think of them. Otherwise, you will forget. We will bring them up when appropriate. Without further ado, please let me introduce this webinar's chair, Renato Pestana, former group treasurer at Vantiva, at Essilor, and who has had senior leadership roles at TNT, Intel, and other very large organizations. So with that, Renato, it's over to you.
So thank you, Marielle, and welcome everybody. So first of all, I would like to say that I'm really thrilled to be hosting this webinar, not only because the subject is quite interesting, but we do have, in terms of a corporate, we do have what I would call the best of breeds in terms of an in-house bank setup. So I hope you can enjoy, as I will, all the knowledge that we have and all the years of experience in in-house bank that we're going to be having today. So having said that, I will let the participants present themselves and which company you belong to, which kind of industry. I will probably say, Magnus, would you kick it off?
Absolutely. So my name is Magnus Svensson. I work for T Connectivity. I'm a senior director, America's treasurer. I'm managing the global bank relations as well. I've been in the company for about 18 years. In a month, I've been here for 18 years. Started treasury about 24, 25 years ago. So been around for a while.
Dirk, would you go next? I'm going on the size on the disposal of my screen.
Yeah, more than happy to. Thank you, Renato, and also a very warm welcome from my side. My name is Dirk Kronshage. I'm with Deutsche Bank here in the Frankfurt head office, and I am part of the corporate cash management division in a product advisory role where we are on the one hand side supporting our sales and coverage bankers in their client interactions when the topic is indeed about centralizing certain treasury activities. And the second part of this role includes then to translate client demands into product development priorities, whether this is for payments or collections or liquidity or other product areas. So I'm very happy to be with you all here today.
Thank you, Dirk. Florent, would you go next?
Yes, thank you, everyone. My name is Florent Legault. I'm working at Schneider Electric since 2016. So Schneider is a global specialist in energy management and automation. Since 2020, I'm in charge of, I'm director of cash management, so in charge of the management of the global in-house bank for all the cash management related topics, both the run side and let's say the project side with the optimizing the processes.
Okay, Stefan?
Yeah, thanks, and hello everyone. My name is Stefan Windisch. I'm the global head of in-house bank for Roche. Roche is a pharmaceutical and diagnostics company located in Switzerland. A brief word to our in-house bank. We introduced it in the early 2000s, so more than 2 decades ago. And today we basically have a fully centralized in-house bank serving the entire group. So basically all markets around the world with roughly 240 connected participants.
Thank you, Stefan. Before we go through, and I probably would like to make another roundtable in terms of just that we set up what is the in-house bank structure. Claudia, would you mind to launch the poll just that we can feel from the audience what's the stage of each participant on where they are? And please make sure that you go through, you might have to scroll down on the screen to make sure that you click in all the possibilities. So let's give a few minutes to the audience so they can look at the poll. And Claudia, I think we probably could be showing the results, and I think that they will, as participants keep keying on, we probably will see it coming through as well. So if you could show us, please, the polls result. Okay, that's really interesting. So what we see and would be, you'd say, expected is a very high percentage on the cash pooling, cash investment intercompany loans. So this is, I think that gives us a little bit of insight. And of course, I would say the second place coming to the netting part, which is quite expected. And I really appreciate your response. So having said that, before we go on the more specific Q&A, could we go in the same order, Manus, Florent, and Stefan, give us a little bit of sense of what you have in terms of how mature and what's the scope of your in-house bank?
Absolutely, and it's very interesting to see the responses here. But for T connectivity, we were formed in 2007 out of a split from Tyco. And from that, we kind of had an idea of what the in-house bank or the treasury group should be looking like. And what we had in the beginning was kind of a decentralized structure from a banking perspective. But all aspects to what you saw on this poll, which includes, cash pools, loans and deposits, contingent liabilities, et cetera, it was kind of there, but, bits and pieces here and there. So from our perspective, we worked a lot on making sure that the centralization parts of everything was working properly. We obviously had our, regional setups. We have APAC Center, we have an EMEA Center, and we have an Americas Center. But we kind of started working together. We formed, global structures, global cash pools. Obviously, the in-house bank, which you could look at from a lending and borrowing perspective, but also making sure that things like contingent liabilities, they're managed from a central point. The insurance programs that we have, hedge programs, et cetera. So it was a lot of making sure that everything gets centralized, where you have a central point of contact. It's easier from a negotiation perspective, and so on. So that would be my 5 cents to it.
Okay, thank you very much. Florent, you want to go next?
Yes. So clearly within Schneider Electric, I will go very shortly on the cash pooling, intercompany loans, and so on, because we have seen that the audience, this is typically the most let's say widely used. So we definitely have it. What we have pushed a lot in the last years is the POBO, simply because we do consider that POBO has a lot of advantages to lower the transaction cost, especially when you are getting access to the local clearing systems to decrease, let's say, the lifting fees and so on. and to tackle one thing which is mainly ignored in many companies, which is the implicit FX. So entities making implicit FX transaction with their banks because paying in a currency which is different from the account one. So we bring it brings a lot of added value to POBO today, and as well we do centralize a lot the intercompany netting. Again, I think this is one of the main responses of what is deployed today. But we do centralize hedging, especially foreign exchange and commodities, to benefit from all our, let's say, IT infrastructure and the, let's say, the capacity we have to bargain with banks through Bloomberg and so on, and as well to get a more accurate view on risk. It's not only processing on behalf, but definitely when you are centralizing, it's a way as well to have a bigger control on the operations from the entities. So definitely.
Yeah, go ahead. Apologies, Flo.
Just one thing, it requires a proper IT environment. This is something to consider, and this is what we have learned from our experience, especially from a payment perspective. And definitely at the end, there are some economies of scale, but you need to have some proper skilled people, because managing on behalf of is not simply managing multi-entities with their own domestic process, but you have to have at central level some kind of knowledge of all, let's say, the local specificities and so on. And the only thing, if I want to conclude on our experience on this, I mean, there is no one in-house bank configuration. You can have several processes depending on your level of maturity, your appetite as well to centralize or not. But at the end, we can see, especially on our side, but discussing with other peers, that it could be driven as well by the corporate culture, and the culture about centralizing or not definitely might have an impact about the way you want to centralize, smallly, at medium's way, or very strongly.
And before we go on, just a clarification for the sake of the audience, what you mean by POBO, and you might want to explain what SCOBO means as well, so we are all on the same page.
Payment POBO is the fact of centralizing the payments not only within the tool, but centralizing within one legal entity. So the fact that one entity will not pay using their own bank accounts, but they will ask another company within the same group, typically the in-house bank, to make the payments on its behalf simply. And afterwards, you have a game of intercompany impact and so on, exactly as for cash pooling and so on. So that's it. It reduced the number of bank accounts and so on and so on.
Great, thank you. Stefan, shall we have your inputs?
Yeah, sure. So I try to keep it short. So our in-house bank, as I said earlier, is started 20 years ago, more than 20 years ago, and we were basically trying to sort out the inefficiencies through a defragmented setup around the globe. We were starting with cash pooling, intercompany settlement, trying to in-house certain services acquired and generating efficiencies along the process. We connected to SWIFT. We introduced payment factory. We introduced collection factories, payroll factories, and basically built a cash management on top of it. So, and on that side, we basically see exposures from all our entities around the world, all the different currencies. Of course, hedging is a key service we deliver to the group. We consider this in the cash management, and then we have the trading on top. So really the deal creation to invest money into the external market, and then also having the confirmation process through this fully automated, so that at the end of the day, once the deal is created, the deal is matched and settled, the payment run goes out for the treasury payment as well. We have COBO, we have POBO, we have also many other things on behalf. So besides all the list which was in the poll, we also offer certain banking solutions. So we, for example, offer an only in-house created e-banking tool for manual payments, as well as for salary payments. If they're in smaller locations, they have a file upload, for example, which is then triggered a payment out of our in-house bank. The difference, though, is that we always had the belief that we should see payments ahead of the fact. So basically, once they are just, or even before they are sent to the bank, so that we know from a liquidity needs perspective that we can cover this. And for some of the companies, and we will come to that piece, we really are the complete bank partner.
Okay, that's great. And before we go to the specific, I have some questions that I would like to go around, but we have a question from the audience, Florent, that's for you. When confirming commodity hedge, is the automated, and if so, which system, or is still using long confirmation? Thank you.
Do you answer now? Yes.
Yeah, please go ahead.
Okay.
And,
Okay.
just,
So one thing. So for FX, we have the same as Roche, because this is very standard with MT300 and so on, and we're using the platform from Bloomberg, CMS. But clearly for commodities, this is less standardized and so on. So we have an initiative with some other, let's say, corporates having some similarities, and some would like to get some benefits from commodity hedging. But at the moment, no, we do not have. One thing we have to consider, we do not have the same level as well of commodity deals as we do have FX. So it was not the first priority, but this is something we consider for the future.
Okay, thank you. Stefan, I would go back to you. You were talking about the process, the visibility that you have, how you manage with an in-house bank, have all the visibility. What are exactly the tools that allow you to have all the visibility on different, on the flows, on the FX exposures? What are the elements and the tools that allows you to have this visibility?
I mean, it starts early on with literally a principle to put in place, which is that we want to reduce connectivities, and the connectivities between the Roche Group and the banking world should be our in-house bank only. So early on, when we started implementing the in-house bank, we were basically just cutting all these connectivities and said whatever is needed has to go through us into both directions. So basically, if there's a payment instruction, it goes through us, but also if there's a bank statement coming back, it goes through our system, which then generates the visibility. The way we did this is that whenever an entity joined the in-house bank, and of course, this is nothing you do overnight. This was a lengthy project on a country and regional approach. But whenever we integrated a new company to the in-house bank, we went there and we tried to understand their needs. At the same time, we were bringing to the table our understanding of how certain processes should be. So, we had in the same country, we have different divisions, different companies having the same processes. They need to pay vendors, they need to pay taxes, employees, and they collect from customers. And there is no need to have, for the same process, two different solutions, which is why we could really gain efficiency, big picture overall, with just applying same logics all over the place. And of course, this approach was then on this journey further supported with the implementation of shared service centers, which was exactly looking for these standards and alignments. And we were a little ahead of that implementation, and we benefited both, so to say, just talking and exchanging each other and having the full end-to-end process view.
Okay, no, that's fantastic. The problem, the next one, Florent, you have mentioned you would see a different type of in-house bank as a services, or different type of implementations. What do you mean by that, and what could we extract here for the audience as well that could understand different models that they could be pursuing?
First thing is related to the services you offer. Clearly, when you are starting to think about centralizing some treasury operations, typically you are considering about centralizing cash, so ZBA, cash pooling structure, and so on, which is the first level. Afterwards, I said that we could have payment on behalf of intercompany settlement and so on. Wow. So this is typically the different levels of services you can provide within an in-house bank, within a group. Afterwards, when I'm considering the different, let's say, possibilities in terms of in-house bank, we have not discussed, which is we might have, and this is the case at Schneider, we have regional in-house bank. We have one main in-house bank covering some stuff, and I have seen that there is a question in the chat about in-house bank in the US and so on. Definitely, for some concerns, we could have the capabilities for regulated, but as well for non-regulated. But let's assume for regulated countries, for instance, in some regulations, we cannot consolidate the cash cross-border to our in-house bank, which is in France for us, but there is a capability to optimize the cash concentration within one country. So it's kind of regional in-house bank, allowing at regional level or at country level to consolidate the cash. So this is the way, and afterwards, I do consider that when you have the global in-house bank for most services and some regional hubs with regional in-house bank, it's kind of, let's say, a more mature model than simply considering I'm just promoting cash pooling without any other services and without any other hubs based on the regulation constraint and so on and so on.
Okay, no, that's I think that's a really important point that you have brought it, which is the distinction between in-house bank and cash pool, having a local or regional cash pool or several regional cash pools and a local or regional in-house bank. So, Florent, thank you for this observation. Magnus, for setting up an in-house bank tax-wise, is that easy, or should we be worried about how we're gonna price loans, intercompany, current accounts? What would be the advice that we could have from you?
Yeah, so I'm going to be very careful in answering this because I'm not a tax expert, but I assume that everybody working in Treasury, they have one way or another been approached by their tax group. There have been recent development on the OECD, minimum tax rates, et cetera, But one thing that you should definitely keep in mind when it comes to taxation, cash pools, lending and borrowing would be how you're setting up your structures, like from where you're lending or borrowing, et cetera. One issue that we have been seeing a lot is tax audits, various countries, not going to mention any specific, but where questions arise with regards to how we come up with our interest rates that are being used, whether it's in a cash pool or whether it's a normal intercompany loan or intercompany borrowing. So how do we come up with spreads? Why are we using a specific rate? Can that be backtracked to a specific benchmark? So I would assume there that what you want to do is really make sure that you have documentations, like proper documentation as to why you did a specific thing or why you set a specific rate, and how can you back that up if there is an audit that would arise from looking through balances. And this goes on anything that you would collect in a cash pool, for example, or you collect a deposit from a subsidiary and then you reinvest it on money markets or commercial paper, et cetera. You need to have that properly documented so that when the tax authorities come in and ask for specific questions, you have a proper answer for them.
Okay, so if I understood you correctly, you need to have a bulletproof process well documented to prove to the tax authorities, right? So I think that's a really important point while talking about in-house bank. Dirk, what are the trends that the drivers that you are seeing on your side as a banker, right? That you see corporates asking and demanding from Deutsche Bank.
I would put it as follows. It first of all depends on where you are as a corporate in your journey towards centralizing certain treasury activities. I think it has become very clear from listening to Magnus, Florent, and Stefan that they represent corporates, mentioning again what Stefan said earlier, who are on this journey for as long a period of 20 years, if you will. So I think for corporates on that end of the spectrum, I would say that the demand really gravitates around realizing the next incremental level of efficiency, the next level of incremental automation, because there is already an extremely mature foundation and treasury infrastructure in place. When we look, however, to the other end of the spectrum, those corporates that are currently in the process of assessing and contemplating to centralize certain activities, I would say there are 3+1 main drivers. The three main drivers, and I think this will not surprise anyone in this call, tend to gravitate around liquidity management. And And it's also reflected in the snapshot survey that we did in the beginning. That's the core task that is commonly or that commonly prevails with the centralized treasury setups. Second aspect that we hear a lot, and it depends obviously on the organization, is to get a better handle on the FX exposure, both in terms of liquidity, stranded liquidity in foreign currencies, both core and non-core, wherever that may sit, especially at a decentral level. It's clearly an item of concern. And the third element really is around looking at ways and means to get a better handle on the payments process, both outbound payments as well as inbound receipts. So these are the three main areas. And I said earlier, 3+1. What do I mean with the +1? It is something that is, I would say, a trend that is emerging in recent years, where there is an extension of the role, I would say, from being a provider to a true business partner to internal stakeholders, business lines, product divisions, especially when it comes to the question of how can one leverage the undoubted existence of competencies, skills, and knowledge around how to do banking in not just multiple countries, but also how to basically position yourself vis-a-vis completely new payment methods, something that we have seen a lot in the aftermath of the COVID crisis, where online distribution channels have enjoyed a far greater attention and focus. It has prompted the need for a different skill set also in the central treasury function. So in a nutshell, to summarize what I've said again, it clearly depends on where a given corporate is in its journey or in its trajectory towards establishing and building an in-house bank that caters to the varied needs of the group, or whether you are indeed at the outset contemplating to prioritize what should be the next activity that is prime for centralizing.
Okay, great. I have a question from the audience, which I would definitely join to a question from myself. I would address it to Stefan. You were saying about the bank accounts, right, or having multiples or no bank accounts, and I understand that around 30% of your entities would be using a centralized bank account. I have a question from the audience. After implemented a house bank, is it possible to eliminate all operational bank accounts, or do we still need local accounts for a specific type of payments or receipt? Stefan, could you please comment on your experience, how you deal with opening or not bank accounts?
Yes. So the short answer to this question is yes. However, it depends a bit on the location, on the market, and on the legal framework in these specific countries. As you correctly said, we have roughly a third of our entities connected to the in-house bank that are bank-free. So this means they don't have any direct relationship with a bank. They don't have an account in their name, in the cash pool, or anything like this. The only bank partner for them is the in-house bank. This is something which we gradually introduced over the last decade. So I think the first entity we made bank-free in 2012, 2013, something like that. When we basically really shut the bank account down for them. What it takes is, I think payments on behalf is relatively easy to execute. Collections on behalf is technically easy. You need to have on an in-house bank side a very highly automated solution. You need a bank partner which can provide you certain solutions with this. Dirk was and Deutsche Bank were part of that journey since early on. Client 001. But we have launched this in many locations and also with different banks, to be fair. When you approach this journey, it simply means you as the in-house bank have to cover every need an affiliate may have for them. For FX, payments, collections is clear. Bank guarantees, checks, loans, maybe cards. etc. So whatever they have, whatever they need, whenever they would go to a bank, you need to make sure you can cover this. The advantage is you have full visibility on what's happening. So also when implementing this in country by country, we actually stumbled over a couple of things which we didn't expect, and we could take it out. So from a risk and compliance perspective, this was a very interesting journey. And of course, we made things more efficient. But you're not just taking the bank account away and the relationship away. And actually, we didn't only reduce bank accounts, we actually terminated entire bank partners from a group perspective. So because we could really cover them. So from a counterparty risk perspective, this was also an interesting factor. And you make things more efficient, and you need to deliver value. You know, some people, some colleagues locally believe if they can quickly check online and maybe credit and clear a certain invoice, that this is better, that this helps them, their business. But if you take that problem and you deliver a solution to this with an intraday collection, with visibility instantly, despite the on behalf setup, then you exactly take this, but you take out all the other facts, because it also means many people around the Roche world are not registered with a bank, so they don't need to update their passports regularly. They don't need to deliver certain documents going on, or if they rotate in their roles. Everything is done centrally. It is group legal, group tax looking into the setup and into the contracts, and all of this eventually takes out risk of the entire process.
Okay, so I think that's a very good point, Stefan. So we are seeing that a lot of the benefits, right? If we were to be discussing bank rationalization, probably would fall under what you have said. You previously said about cost, and we previously said about visibility. So I think that's a very good point. I have another question from the audience, but also from myself. This to Dirk on the virtual accounts, right? How virtual accounts would, the question for our audience is, do any of the panels set up with these virtual accounts to facilitate the in-house bank structure? If so, how? And Dirk, I also would like to if you could comment how virtual accounts could be used on in-house bank setup, and of course on COBO, POBO, how it's the best case in use of virtual accounts.
Yeah, thank you for that question. I think it's the way how I would like to put it is perhaps that we consider virtual account solutions to be very complementary when it comes to implementing an on behalf of structure, whether it's payments on behalf of or collections on behalf of. What do I mean by that? It is really about looking at, or the starting point for any corporate that is contemplating to implement these OBO solutions, is to first and foremost take a very critical look at what's my existing bank account footprint. Now, it may sound very trivial, but the experience that we are making is telling us time and again that the degree of efficiency that you can realize as a corporate is ultimately a function of your existing bank account footprint. So the more bank accounts you will maintain in your individually defined target state, the more or the less efficient you are going to be. And that is where virtual account solutions can and are a big enabler towards reducing your bank account footprint as much as practically possible. And I suppose the emphasis here is really on the word as much as practically possible, because there are indeed jurisdictions where for certain mostly local reasons that are outside the banking sphere, you will be required as a corporate or your entity to maintain existing bank accounts, whether you like it or not. So that's a fact. But then on the flip side, and again, this is something that we are seeing consistently in the client projects that we are supporting, there is very often a lack of awareness from a central standpoint. Why have certain accounts actually been opened with an external bank in the first place? And when we overlay that then with the analytical capabilities that we can apply nowadays, we are finding very often that there are quick kills, quick gains possible in the order of 20-25% of a given corporate's existing bank accounts, where you have so little traffic going through that you don't really need to talk about how do I consolidate the payment flow or the cash flow going through these accounts. You would rather say, this is something that I can immediately reduce and eliminate. And then there is the next set of accounts where indeed it is about taking the transactions away from the bank account that you have, moving them into an on behalf of structure, which has the immediate side effect that the liquidity is sitting in a single bank account or in fewer bank accounts than it presently does. And that's something where that goes back to the point I made earlier or initially when I said it can be highly complementary, because reducing bank accounts, consolidating cash flow in fewer accounts means that you can collapse and at least partially eliminate some of the physical sweeping structures that you may have in place. So going back to where we started, what is the role that virtual accounts can play in terms of enabling an on behalf of structure? They are highly valuable and they are highly relevant, and they are, one might say, the tool of choice, going back to what Stefan said earlier, to really achieve that optimal target state, at least for a certain part of your participating entities, that you get them completely bank free and consolidate all their transactional activity on the payment side initially, and by extension then also for related activities like AFIX risk management into the in-house bank.
Okay, perfect. Thank you, Div. There is another question from the audience that I would address to Manus, because I have a question for you as well, Manus. So the question from the audience is, how would you deal with a divisional treasury CEO who are just not comfortable in losing their bank accounts and votes very strongly against, even have all the benefits that have been shared and discussed it already? I would complement with my question with what are the journey when you're setting up, and I have a second one, which probably a question from the audience that we had earlier on the business case of in-house bank. So how do I convince people, your peers, right, within the company, that in-house bank is a good idea?
I think it goes back to ROI. You know, in most cases, you want to see what good does it do for us. But to this specific question, it is very accurate. You know, it's like, how do you, I shouldn't say persuade, but how do you sell the idea of potentially centralizing something or taking away the control of the local teams when centralizing into a, either a regional treasury group or a global treasury group? It's a lot of work. But on the other hand side, saying that, one of the reasons TE maintained its regional treasury group, although we report to one and the same person, it is about having local contact. So making sure that you have local knowledge, you have the local relationships, you can explain in a completely different way than if I'm sitting in the US, have no idea what's going on in APAC. At least I know a person that works in our team that has full information and she has full knowledge of what goes on in the region. So having, local knowledge, not only from a business perspective, but also from a banking perspective, because then you have certain local relationships with bankers, etc. So you can support in a completely different way. But having that discussion is obviously something extremely important, being transparent about what it is that you're trying to achieve, showing examples, or like, as I mentioned in the very beginning, the ROI, showing calculations and examples of this is what I want to do. This is the expected outcome based on discussions that we've had with various banks on the specific matters, or only if you want to centralize funds and utilizing the centralized funds for lending to entities that are in need, decreasing interest expense, etc. So it is, a lot of work that has to be done, but it definitely pays off in the end. And majority of the entities, if you have local CEOs or CFOs that have, issues with what it is that you're trying to achieve, just keep on working on them, making sure that they understand at the end of the day that this is why we're doing it, and it will actually benefit you at the end of the day.
Okay, thank you. And I think I probably would complement how centralized or decentralized your treasury organization is. I think that's a key point. Thank you for that. I would pick up other questions coming from the audience, and I would address to you, Stefan. How feasible is the implementation of a payment factory via an in-house bank across Europe and Asia? What key factors should be considered before its adoption?
I mean, we have one in-house bank serving both regions at the same time. We have we implemented the payment factory because of owning the connectivity to the outside world. And with that, we are also in the ownership of the different formats, which are in the details, which are basically required in all the different markets. And this is what we have to deliver, that every instruction is correctly executed then. So what Magnus said, this expertise of the different markets we need to have in-house, whether this is now in the regional center or in the headquarter, it doesn't matter really. But this is a true requirement. It's absolutely possible. I would say in Europe it's a little bit easier. I think the market is a little bit easier. And if you implement basically on a greenfield, go straight into a full on behalf setup versus introducing a cash pooling structure that is not required. There are too many advantages of having a full on behalf setup versus a cash pooling structure, especially for Euro, where you have in multiple countries the same currency with the same regulation behind.
Okay, thank you. And one which is interesting as well is Florent, I would address for you if you would be comfortable in responding. Otherwise, we can see another participant. How do you manage the data privacy laws from the various countries, the GDPR from PR from on countries like China, India, when your data is circulating somewhere else?
Okay, I may not be the good speaker for this answer. Maybe Stefan is the best. Let me clarify why. This is because at Schneider we have a different strategy. We do consider that in-house bank is responsible for tackling all non-sensitive flows. So meaning mainly all cross-border plus domestic when this is vendor and so on, simply because we do not want at Global In-House Bank to take the responsibility of having an issue with payroll, with tax authorities locally and so on, not paying on time and so on. So we do not have such constraints, and we do consider that this is the responsibility from the local business. And in terms of volumes, we are tackling the rest, which is let's say the biggest, and all, let's say, foreign currency payments as well.
Thank you, Florent. Since Stefan Florent did throw the ball on your court, I would join his question with another one that I have from the audience, which is, what about entities tax payment, right? So you were saying paying on behalf. With what Florent just said, what about more sensitive countries? How we do it, the tax payments? Do we need a bank account? Can you use a virtual account, or can you use a centralized account for it?
Yeah, so maybe to the first question from Florent. So of course, an in-house bank is not a construct which allows you to breach any law. If there's a law in place in China or elsewhere, you need to comply with it and need to find solutions. So if there is a restriction in having sensitive data outside the country, then you have to follow this rule, and you have to find a solution in the country. To the second question regarding the tax payments on behalf, the tax payment per se is, I would say, least of an issue, because also tax authorities, they're actually just looking onto their bank statement, trying to understand who paid. So if you're able to deliver the supporting reference and you pay in time the correct amount, they may just clear it. This is, sometimes we hear similar concerns from even employees receiving their salary from a different legal entity, even outside the country. What is a bit more tricky is a possible tax return payment, because tax authorities, they need to actively pay to an entity in their country, but they probably have to instruct to an account number into a different country, to a different legal entity, maybe, you know, with a, with just a different country codes of the account number, even a virtual account, if they may realize that. The answer is the same. If there is no law forbidding this setup, then it's possible. And of course, these are the questions always raised whenever you come with this a project into a country, and we basically turn the question around and say, prove me it is required. So which is why if there's no proof, then we basically went on. That's, let's say, the very short story, it's a very short version of it. And yes, there are certain markets which require to have an account in the name of the entity. It doesn't go any further and say, but you have to use it. You know, there's also certain solutions that we have an account in the name of the entity. It's in even part of a zero balance cash pool, but it's literally dormant. All the activities, the payments, the collections, even the tax payments, even the tax return payments happen through the on behalf structure. So this is maybe a bit of a stretch, but it's possible. And you know, we fulfill the law, and this is it. So, but you can separate. You know, we also have setups where we have certain flows in one direction, but the majority of flows in another solution. So it depends. But of course, you know, as a healthcare company, we are selling to authorities. You know, we cannot. There's no space to do anything wrong.
I think an easy explanation as well, Stefan, would be to just say that it's a case-by-case decision. So you look at each country and you look at the potential. I think one of the concerns, if you read between the lines, would be, well, if we pay late in a specific country, you know, there's massive complications, or there are massive fees, or, you know, penalties that you will be reached. So specifically, you look at a POBO, you can just tag whether or not that specific payment should go through the POBO, or you just say, for these specific tax payments, you do it locally, because we do not want to risk or jeopardize missing that payment. Yeah. So it's a case by case. And I would agree to say, like, if you can do it, do it. But if you see that there are issues, potential issues, that would cost you even more money than it should, then do it the safe way and keep going.
I mean, you know, I have had a lot of exactly this discussion, and whenever there was a strong demand for having a local account for exactly this purpose, we have seen cases where then exactly that account, which was supposed to only be there for tax payments, was used for this quick payment, you know, and this little invoice we just needed to urgently execute. And this is exactly the moment where a local finance organization interferes completely into a fully automated process, because yes, they have just quickly authorized it and executed the payment, but what then happens in the shared service center, who maybe forgot to block the invoice and it went out a second time, or who is just seeing a debit without having an invoice in place and it's just running after that. So this inefficiency is exactly what you need to come over, and this is exactly then also what the CFO actually understands if they come a little bit with the holistic view. So if there is no true law requiring a bank account, then we can close it.
That's a very good point. And Magnus, once that you jump in, I would address this one from the audience to you as well. How could you do in-house bank work efficiently without a payment factory, and vice versa? What are the limits, the pure centralization of financial operations without optimizing payment processing? And I think this one comes to the spectrum of your in-house bank. Could you please comment?
Yeah, and that's actually a tricky one, because I would say the way you would build a in-house bank would be, you know, take step by step. And at least what we did, we had the cash pools there first. So setting up a payment factory or vice versa without the other, I personally would see problems because of how you reconcile lending and borrowing. Because let's say that you want to set up a payment factory without having an in-house bank in place, you obviously start paying on behalf of, which means that the entity on which you're paying on behalf of, they owe you money. So some way you're causing a borrowing position, and that needs to be taken into consideration. Then you have to look at, I mean, I can start talking about taxation and all of this stuff as well, because once you have this, you need to look at, do you want to have additional borrowing on top of what you already have? How is that going to impact your day-to-day operations, and how the tax group is going to look at you? So I would strongly suggest that you have, potentially a cash pool in place already, and when you add, a payment on behalf of, or a collection on behalf of, for that matter, you have same-day reconciliation. And the reason for saying same-day reconciliation would be that then you avoid that additional lending and borrowing relationship, and just, it's like reconcile or consolidate everything into a single cash pool position instead. So I'm sorry I'm not able to answer that in a better way, but one without the other, I'm sure it would work. But from my side, looking at how we are structured, it would be highly unadvisable. Like it would not be a good thing to go ahead with.
Thank you very much. We do have another 7 minutes, so I'm seeing some really interesting questions here. I'm trying to address them as we go. The next one probably for you, Flon. Does the in-house bank setup streamline or make it more cumbersome reconciliation with the general ledger? I think this is a really good point.
I mean, when we are dealing with general ledger, so we are purely, let's say, at accounting side, and definitely when you are consolidating, centralizing the processes within one in-house bank, I mean, the volumes are much and much bigger. This is why you need to have, let's say, a very strong IT and process architecture. I think I answered another question which was close to this one in the chat. So again, the same. This is not that difficult, for instance, to make a payment on behalf of an entity. You just have to send an instruction to the bank. It should be well structured, more or less. But afterwards, when you have this payment to be reconciled with what was done in the ERP for this entity, and potentially to say, okay, I could have a reject because the beneficiary of the account is closed and so on. This is just one illustration, but in other words, it's not, let's say, a simple response. It's just to say, okay, the IT design should be very relevant to make sure that you do not forget anything between the payment factory, if you have payment instruction for POBO, for instance, the TMS, which is the heart of this, let's say, in-house bank engine, plus the ERP. Any lack you could have in the design and so on, definitely, the more difficult it will be to handle it afterwards. So again, it's more to be very rigorous, to describe well what would be the processes, to make sure that this is well prepared.
Thank you. And again, we do have 5 minutes. I have another question for Dirk on innovations. What are the innovations you see coming through the in-house bank, Dirk?
I think if we were to go back in time by let's say some 5, 6, 7, 8 years or so, when one would speak to customers, the answer that you would probably get is, oh, an in-house bank is something that is is only doable for large corporations, MNCs, the Fortune 500 types of this world. And the common perception back then, at least, was that it's complex to create, it's costly to build, and also costly to maintain. What I think we have seen in recent years is a trend which has made, and I'm generalizing now a little bit maybe, but the access to treasury technology or IT tools that are relevant for technology. These tools have become so much more accessible and also at lower cost than that was perhaps the case in the past, that going down this path of centralizing treasury activities in line with your individual priorities is something that is of much more interest to corporates of a smaller size nowadays. Now, what do I mean by that? I said earlier, it's the perception, common perception, or rather fact back then was it tends to be costly to maintain. What we have seen in more recent years is that through the availability of or the possibility to buy, purchase computing capacity in the cloud, building such a centralized infrastructure was no longer immediately associated with having to run a large-scale IT project where you need to install another big application in your own premises or onto your own IT infrastructure. So that in itself has led, as I was mentioning before, a lot of corporates to really reconsider, hey, this is something this could be now for me. So definitely on the innovation front, a lot has happened in the external marketplace. If I were to compare and contrast that to within how we are going about this within DB, probably same period, 5, 6, 7, 8 years ago, we would have said, let's build it in-house. But nowadays, the way how we go about enhancing existing product capabilities or bringing new product capabilities to the market is that very, very early on in the product development cycle or innovation cycle, we ask ourselves the question, should we buy something? Should we build something in-house, as we may have done in the past? Or should we look for partnering options? And there are, as the British have a phrase for this, horses for courses, they call it. I think certain areas lend themselves more towards a buying approach or a build approach or a partnering approach. You know, there are, if we talk about partnering, for example, there have been, and there will continue to be cases where corporate treasurers will unlikely want a bank to process data pertaining to the entire corporate organization. Yeah. There are other cases, however, where we as a bank may well say, hang on a second, this is something which adds or complements our existing capabilities nicely. So let's buy existing technology that is already there and look at ways how we can integrate this meaningfully and effectively into our own offering. Yeah. So it's a highly dynamic place for sure. If there's one concluding remark, I would say that we definitely have seen greater choice and also greater competition. And that is definitely something where the corporates are a clear beneficiary from.
Dirk, thank you very much. I think we are at the time to wrap up. We had probably some questions on the audience that were really interesting. Unfortunately, we ran out of time. I probably leave to Marielle to make some final comments, but I really appreciate, so I thank you all the panelists, but also the audience for this engagement. Marielle, I leave up to you.
You're muted, Marielle. Still muted.
Still on mute.
I'm so sorry. And thank you for letting me know. Now, just before we go out, I just wanted to thank Renato for chairing this session and the speakers for sharing their experience and best practice on this very complex and interesting topic. I would also like to obviously thank Deutsche Bank for making this event possible. And finally, all of you for being here. I hope you found the session helpful. As Renato said, there were quite a few questions. So maybe we do another one and we'll continue with the topic next time. In the meantime, please feel free to continue this conversation with the speakers and colleagues at the Global Treasury Leaders community. You can join us using the link I shared with you earlier on the chat. And through the platform, you can exchange experiences and ask questions to all members, and we share contents on a regular basis. Our next webinar will be probably in March. I will be sharing information shortly, so please watch out for our emails. I hope to see you then again, and thank you very much. We'll see you soon. Goodbye.
Thank you. Bye-bye.
Thank you.